much for attending. We appreciate it. This is a very complicated area, foreign trust tax compliance. We cater to a lot of CPAs and financial professionals who find themselves in compliance issues. Really, we present this. There's quite a bit of detail, but we really present it such that when you after you see the seminar, you'll have an idea of how to spot issues. You know, what are the circumstances under which things come up. Let's move to the agenda, and we're going to let you see the whole slide here. So we're going to turn off the little camera. Yeah. Okay. Sometimes it works, sometimes it doesn't. So here's the agenda. So we're going to go through some background as to how the estate and gift taxes work. One thing, and what's really kind of a good takeaway from this presentation, we've done it a number of times, is how you can distinguish as part of planning estate and gift tax from income tax. Sometimes you'll fall within the estate tax net, your client will or you will, but you won't be subject to U.S. income tax. Sometimes you'll be subject to U.S. income tax and you won't be subject to U.S. estate tax. It allows for a lot of planning, and as you'll see, especially with respect to the foreign trust, it's an issue that you have to be very, very cognizant of all the time. Here's a little overview of wealth transfer tax. I'm going to let Brian get into some of how that's changed over the years in terms of what we now have a portability issue, how gift tax works, and then some of the basics. Go ahead, Brian.
Sure. Well, I mean, this is all found under subtitle B of the code, but we have the privilege in the United States to pay an excise tax on the transfer of assets or wealth. A lot of times when it comes to compliance, a lot of individuals believe that, okay, well, I have a gift, I filed my gift tax return, I'm done. Not understanding that if you have a foreign trust or a trust that might become foreign later on, that there's a component of compliance that might be totally missed.
Not only compliance, but planning.
Absolutely. And this is, true for U.S. citizens and U.S. residents, or those that want to become U.S. residents at a time.
Yeah, we unfortunately probably I would guess 70 to 80% of the people abroad who are involved with foreign trusts or intend to come to the United States with substantial wealth have no interest in planning. A lot of times, like, people are coming from very low tax jurisdictions associated with estate and gift tax. We've had meetings where we tell people that the estate tax is 40% of the wealth that they're basically everything they own. And we have to take a pause. We may have to find a defibrillator, at least a coffee, because in their home country it's 3%, it's 2%. It's kind of a much less significant issue. And the last thing that we want to do is bring in all the assets that are abroad. Like, they may have 10% of their assets in the U.S. What happens a lot of times is by becoming a U.S. person, they now have made a tiny issue into a massive issue, and a lot of times they're already here. They didn't do any planning.
Right. So just as a basic overview, right now our current credit amount under current law is 11.58 million for each individual here in the United States, and it's unified for both the gift and the estate tax. And that's just a matter of and a function of when the transfer is made, either during life or at death. It is interesting, just as a small aside, that with the gift tax, a donor can actually give more with the gift tax and they came with the estate tax, and that's just based on the inclusive and exclusive nature of the tax itself. When you die, the entire value of your estate is taxed. But if you make a gift during life, the donor pays the gift tax independent of the gift.
Sure.
So that's how you, so from a planning perspective, that's something that is missed at times because individuals think, oh, I'm just gonna, I've got my rev trust and I'm done. But there's a lot of planning that might also go involved. There's also income tax planning involved in that, so it's a case by case.
How many times have you heard that? I've got my rev trust and I'm done. Like it's
all the time.
totally at least twice a month we get that. No protection from the revocable trust, no tax planning.
And then lastly, you just have the just to be aware, GST tax, it's there. Since the credits are the same for both, it's usually the same, but there can be issues and times when that might take independent steps of planning as well. And then you have the state inheritance and estate taxes as well. Okay, that's just an overview of the wealth transfer taxes. Now, income taxes. Now, when it comes to a domestic trust, it's governed under subchapter J of subtitle A of the code. And basically, it breaks down how U.S. domestic income taxes, their trusts are taxed. All the rules are there. The most important things to understand and realize are the rules and definitions, which are important as relates to, is it a domestic or foreign trust? And that's going to affect the income taxation independent of U.S. estate and gift taxes. And then you have the different types of trust rules as relates to how you report the income each year, and is it distributed out or not to the bennies. And then you have the accumulation tax rules, throwback rules, and then lastly, is it a grantor trust or not, which means basically is the U.S. grantor, are they the ones that will be responsible for the tax, or will the trust itself be an independent tax entity?
Right, and the grantor trust, you'll see as we get more into the foreign trust issues, having the trust disregarded, that decision to having the trust disregarded is a big one, And in the foreign trust rules, you'll see that this is one of the few areas in tax law where the income tax and the estate tax kind of collide. In domestic trusts, you're going to have your estate tax totally separate from your income tax.
That's right. Just some basic rules here. If you have a domestic trust, each year you'll have to file a form 1041 for the entity itself. The caveat to that is if you have a grantor trust, you may or may not, depending on if you have a FEIN number or not for the entity. But that's something that applies annually. You need to be aware of that. Then obviously the trust itself, if it's independently taxed as an independent entity, it has a tiered income tax rate, and the rates are compressed compared to an individual here in the United States. And lastly,
you hit 40% very, very quickly. It's basically 40%.
$13,000 approximately. You're at the marginal rate.
So when you decide on whether or not the trust will pay the tax or whether or not an individual will pay the tax, sometimes we go with the individual solely because of the rates. If the individual hasn't hit the 40% rate, you're going to save some tax.
And that's why the grantor trust rules are an interesting way to plan because of the rates.
Oh, absolutely. Let's see here.
Okay, and these are just some basic overview of the rules. And the reason that this is here is just to provide a foundational knowledge of the difference between the domestic and the foreign trust, and then the compliance behind both of them. If you have a U.S. domestic trust, there are two types of trust, simple and complex. Simple trust has very strict rules. If these three criteria are met, all of the income is pushed out to the U.S. bennies, and the trust itself basically files an informational return each year.
It's a basic way to have a trust, but it's very rigid.
The most common one of these would be something like a Q-tip trust for the spouse. Give all the income each year, so you have to distribute out all the FAI in a year. There's no charitable set-asides or distributions, and you can't distribute the corpus. It meets those three rules, all three, that's what it is. simple trust. If it fails any or all of those, it's a complex trust, which is the majority of trusts.
Sure.
And just out there as opposed to an individual, compliance-wise, it's important to note if the income is distributed out each year to the U.S. Benny, and if it's income or principal, that's going to affect the return in the K-1. The deductions are obviously different. They're much smaller, and I guess because these were written back in 1954, they haven't
They
updated them.
basically don't exist.
They don't exist anymore. From the perspective of just overview, simple trust, basic terms, you distribute all the income out in a calendar year. Can't distribute out the corpus. No charitable deductions or set-asides. And, it maintains the character of the income inside the trust when it comes out or not.
It's not a major issue. You can account for complex trust fairly easily. This just is extremely basic on the simple trust.
Right. Complex is a little different. It can be tiered distributions. It can be sprinkled. It can be income or principal, which is a main distinction between the two. And this is where it's interesting, though, is if you don't push the income out, the trust itself will pay the tax at the compressed rate. Also, if you have accumulated income from a prior year, we see this all the time, the accumulation tax.
That's fun.
Yeah, it's a lot of fun, but it's there.
For the CPAs mostly.
But the compliance is there, and when someone's under audit and they haven't done this,
oh, absolutely,
it can be a complete mess.
Yeah, that's true.
Okay, those are the basic rules for U.S. domestic trust. Now, the fun stuff, foreign trusts. Now, from the perspective of understanding the distinctions for foreign trust, there are two different sets of rules, and they may come together and they may diverge at times depending on the facts at hand. But for U.S. persons, you have income tax rules and you have estate tax or transfer tax rules, and they're a little different.
Yeah, and also becoming a U.S. person is different from the income and the estate tax side.
But foundationally, all U.S. persons are subject to the U.S. income taxation of their worldwide income from all their assets around the world. And that is if you're a U.S. person. A non-U.S. person is going to be different.
Oh, absolutely.
And for the estate tax or gift tax, it's all based on domicile. And it's based on, if you are considered for U.S. transfer tax purposes a U.S. resident, then you are subject to the transfer tax on the gifts or transfers of your worldwide assets.
So to give you a little background, obviously income and estate assets are totally different. They're totally different sets of taxes. They're different parts of the Internal Revenue Code. But the idea in general is that you don't want to be a U.S. person if you can help it in general. So U.S. citizens are U.S. persons no matter what, okay? So if you are a U.S. citizen, you're going to be subject to income tax by the U.S., by the IRS, on income that you earn wherever you earn it on earth. If you earn the income in another country and the other country taxes the income, you'll be entitled to tax credit, which may or may not cover you 100% for that foreign tax paid. In other words, the U.S. will credit you for that tax paid abroad on the income. And on the estate tax, you're subject to U.S. estate tax on all assets worldwide. The reason we go through this basics in the program before we get into actual compliance is because what happens is when people become residents of the U.S. or domiciliaries with respect to the estate tax, they're taxed pretty much like a U.S. citizen. So you have to kind of tiptoe around the fact that someone wants to spend time in the U.S. or someone wants to buy a property in the U.S., but they're not U.S. residents, they're not U.S. citizens. You have to be careful because the moment that this person becomes a U.S. resident for income tax purposes, all the money they earn abroad, everywhere, even if it's much more money than they're earning in the States, is subject to tax by the IRS. When someone becomes a domiciliary, a resident for estate tax purposes, now what we've done is we've pulled in, whether they have most of their assets in Brazil or Spain or wherever, we have pulled those assets into the U.S. estate tax net, which is the last thing we typically want to do. There are many strategies to avoid that, but in general, that's the risk, that's the danger that we're talking about. And I think we go into some more detail on how that works. Yeah.
Yeah. And so for non-US persons, and from the perspective of income tax,
Yeah.
not transfer tax, estate and gift, the non-US persons have some interesting rules that apply to them. One of the biggest exceptions relates to US situs intangibles, and the ability to sell those assets and avoid the US income tax.
Well, that's right. There's no capital gains on stock sales unless the company, the underlying company, owns mostly real estate. So one thing to keep in mind, if you have a foreign person that you're dealing with, or you're foreign and you're buying and selling U.S. securities, you're probably going to be okay. There's no capital gains tax applicable to you. It's a little known exception. I don't know why. More in reality, the people not living here know more about it than people living here, and even in terms of some of the tax advisors, it's an amazing exception. We've got treaties on there also. Sometimes you can have an income tax treaty between countries, and it's based on domicile mostly. So if you have someone in France who's earning income in the U.S., you may have a treaty exception. So the domicile treaty may say that person's domiciled in France, so only France will tax that person. You don't have to pay U.S. income tax. We've got some differences here. You have a 30% withholding on passive income. So taxation of income also is under a totally different format. If you have basically dividends or rents derived from the U.S. situs assets that are not active are subject to 30% tax, and it's withheld at the source. And then, of course, if you're doing business, this is what we call effectively connected income. Effectively connected to a trade in business is taxed at graduated rates similar to the corporate rates. And then, foreign trusts, as we'll get into some detail here, are in general treated like foreign individuals.
Certain exceptions.
That's right. With huge exceptions.
Yeah.
With huge exceptions, but the idea is that there's tax on foreign source. I mean, I should say it's tax to the foreign trust on U.S. source income, which is the tricky part. And then we'll mix in how the estate works.
Right, and it's important because even though there's an exception for U.S. income tax for U.S. intangibles, you do not want to die with them in your possession.
Well, there's two issues. Well, one is, as we'll get into, so you can buy and sell stock and no capital gains, right? But we're going to get into the estate and gift where you can give intangibles at no gift tax, even if it's a U.S. intangible. You can give them away, but if you die with them, subject to the estate tax. I know it's a tangled web.
And interesting enough,
to say the least.
What is the exemption amount for a non-resident, non-citizen?
Oh yes, it's not $11 million. That's for sure.
$60,000.
Yeah, it amounts to a $13,000 credit. Yeah, it's amazing.
And here we are. Here we had discussed the gifts of intangibles, and it is distinct because it's a big hole in the tax code that you can take advantage of. Mm-hmm. But if you die with them, or if you die with any asset, for instance, U.S. real estate, because of FERPTA and other things, if you have a non-resident, non-citizen that owns U.S. real estate, and they own it as, let's say, they come from France and they buy a home here in Florida and they own it as husband and wife, and one of them dies.
Yeah, we had that case. It wasn't France because we have a treaty with France, but it was Venezuela, and mom died. She was an older woman, and she died. And typically, if they were U.S. people, they were not U.S. people. So sometimes, even though we subject our assets to the estate tax, we actually want to be residents. I know that sounds crazy because it pulls everything into the U.S. estate tax, but it also entitles the decedent to $11.5 million in credit. So we had husband and wife buy a mansion here, non-residents. Mom dies. Mom's entitled to a $60,000 exemption. The mansion's worth $8 million. IRS says you got a $4 million U.S. estate tax, a state burden, which amounts to 1.6 million in tax. No way to get around it. No way to get around it. Absolutely terrible. Now, a lot of this stuff that is not the subject of this seminar. We're going to get into compliance here. Can be avoided in general by creating a foreign entity held by non-citizen, non-resident people. That foreign entity can hold their U.S. assets, and you can generally avoid the estate tax. We're just trying to give you a flavor for how the whole thing works, and then we're going to get into the trusts.
Okay. And then as for the taxation of trust, if it's a foreign trust for U.S. income tax purposes, there are effects and outcomes, and they're all based on the facts of what's going on. And also, the reason it's important is because it affects the compliance. What do I need to file every year? What is important? And
whether or not it's a foreign trust, you mean?
Right.
Yes.
Right. And then if it is, then there are, the factual circumstances may delay certain things and the compliance behind
them. And that may be good, but we want to go in with open eyes is the thing. The problem is that half the people that come to see us have already stepped in and they're swimming in the soup, and we can do some things, but we're limited. So we want to catch people before they've moved or before they've created the trust or gifted assets.
Right, and it's important because it can affect, and it's important who the settlers are, who and where the trustee is,
sure,
and then where the beneficiaries are located. All three of those things may and will have an effect on both the taxation of that entity as well as the compliance requirements behind it. And that is true even if, especially for instance, if you have a U.S. beneficiary of a foreign trust, even if no income is distributed in a given year, there's still a compliance requirement you have to follow. So
the IRS wants to know everything about it.
Right.
It's a bigger decision. I think what we're saying is it's a bigger decision for especially a U.S. citizen to do a foreign trust. Really, it's important that U.S. grantor be totally aware of the compliance issues. I mean, this is not something where you're going to use it to hide or avoid income tax. This is a protective vehicle. It's extremely effective, but it's not to hide or avoid tax.
There are special rules, as you can imagine, for non-resident aliens. They're, as we said, you get a $60,000 credit, but they're only taxed on U.S. situs assets, and that's important. But it's interesting because of the way that we treat a foreign trust under U.S. income tax law is unique because we treat them basically as an NRA, and that's why it's important to understand, why it's, where things are, how they're owned. But this is a big compliance net that over the years they've passed these laws and they're overlaid on each other, but they don't always work the way we think they should.
Well, what's interesting, and Brian and I find this day to day, is the slightest nuanced change can really change both the compliance and the tax treatment, which is good and bad. I mean, a lot of times we can create a very small change to a foreign trust and avoid a huge amount of tax. But when the client goes ahead with foreign trust or transfers assets to a relative or comes into the States without proper planning, it limits our ability to plan. And so now Brian's going to go through, it's just as important that here's where you decide, okay, do I have a foreign trust or do I have a domestic trust? And like Brian said, if I create a foreign trust, now it's taxed like a non-resident alien, and all the income and estate tax rules change.
Right. And so there's a two-pronged test that a trust, if it meets both of these tests, it's considered a domestic trust. If it fails either or both, it's a foreign trust. And this is important, number one, for the income tax consequences that attach based on this determination, no matter when it might change. Also, the compliance requirements change dramatically if you change from a domestic to a foreign trust every year, annually. And so the first test is the U.S. court test to, can a U.S. court bind trust operations? It's called the court test. So if there's a problem with the trust, does a U.S. court have jurisdiction over the trust itself and can bind it?
If not,
it's a foreign trust.
It's a foreign, even if your Uncle Lenny is the trustee,
yeah, Uncle Lenny,
right? If it's formed in Belize, it's foreign.
Right, and the trust document itself will state where the place of administration is, and that's a big giveaway.
And a lot of the foreign jurisdictions require registration.
Right. The other test is the control test, and does a U.S. person manage the trust? And what that means is, where is the trustee? Is the trustee in the United States, or are they outside the United States? Inside, U.S. person manages. Outside, foreign trust.
So what happens, Brian, if I have a U.S. estate, the last of the spouses died, it was a ref trust, it had $40 million in it, and it became an irrevocable trust, right?
Right.
And the kids had no interest in being trustee. They were chosen first, and they resigned immediately. And the backup was mom's brother in the Philippines.
We have a problem.
Yeah, well, yeah, we sure do. So what happened, Brian?
Well, it went from being, we assume on this example that we probably had a Florida trust with a Florida trustee until mom died. Well, once a non-resident, non-citizen became the trustee of the trust, we failed one of the tests. And so we have now converted a domestic trust to a foreign trust. And not only is there a compliance issue here related to filing certain informational returns each year from now on, mm-hmm. we also have an income tax potential issue, maybe, depending on what's in the trust and where those assets, did they receive a step up in basis?
What if some of the assets are abroad?
Oh, well, if they're abroad, at that point as well, there might be some other compliance issues attached based on the nature of the asset.
There's a sneak peek at the next 6 or 7 slides. We want to give you a sneak. So yeah, oh yeah, no, I know. Now you're excited. I know. It doesn't get any better than this.
You've been waiting for.
Yeah.
What this means.
No, this is incredible. So what we want to do is raise the issue, because what happens is it's ignored. Once a month, at least, maybe twice a month in general. People will come in and we try to do some planning, and we'll realize that they're out of compliance. They had a foreign trust, or they had foreign assets or foreign bank accounts that they have not told the IRS about. And now what do? It's backtrack time, and it's no fun.
Now, why is it important, this conversion to a foreign trust or the creation of one? Well, independent of the U.S. transfer tax regime. So if I create a foreign trust, and let's say I use Belize or Nevis or the Cook Islands, and even if I make a completed gift of the assets and I use my credit, my 11.58 million, that's not all there is.
And that was a big decision.
It was.
That was a big decision.
Now, if I have U.S. beneficiaries of this trust, this treatment will be delayed, which just means that it will wait until I die or I no longer have a U.S. beneficiary. But basically, if you make a transfer to a foreign trust, the code says you have made basically they've imposed a deemed sale of those assets at that time. That's under 684. Now it's delayed if you have a U.S. Bene of the trust and you're a U.S. grantor. Nothing happens until you die. But at that point of death, of the grantor's death, or you no longer have a U.S. beneficiary, at that point, the transfer is deemed to have occurred on that date, whenever it is. So this is independent of the transfer tax, and it can be a huge, tax hit depending on the asset.
Yeah. So this is similar to the expatriation. You're sending assets abroad, right? And expatriation of a person, not assets of the person, you're going to be subject to a deemed sale of the asset, right? This is a very tricky section because what happens, it says if you're a U.S. grantor, you have U.S. beneficiaries, there's no deemed sale when you do it. We're going to wait until you die to effect that deemed sale with the capital gains. But you have to be careful because if you transfer the assets and you do it in a way that's not a completed gift, not a taxable gift, so estate and gift versus income, this deemed sales income. So for income tax purposes, we're going to wait till you die until we impose this deemed sale on you, on your estate, really. For estate and gift, we have to decide, are we going to complete the gift and pay the income tax and let the assets rise in value outside our estate, or are we not going to complete the gift? Here's the thing. When we die, that mark to market is imposed on the asset. But if we didn't include it in the, if we didn't complete the gift, it's that those assets are included in our estate and get a step up in value. So it can counter the negative impact of that deemed sale. But what happens a lot is that there's a focus on estate tax planning on these transfers. So if we completed the gift, the taxable gift, we wanted to get it out because we knew it was going to grow in value in that trust. So we completed we paid the gift tax, if any, or we used the exemption, right? When the grantor dies, everyone's excited. There's no estate. He got it out. We're done. It rose in value. Uh-oh. But now there's a deemed sale because he died, and we don't get the step up.
And that's what the appreciation as well.
That's the whole dealio.
The whole thing.
The whole dealio from the time it went. Well, actually, whatever his basis was. So whatever dad's or mom's basis was, it went up. It went up. It went up. We didn't complete the gift. It's still in the. No, we completed the gift. It went up and up and up. It came at it. They die. It's out of the estate. Everybody's happy because we've done our estate plan. But we've got the mark to market. We've got to pay capital gains on the increase in value. It's total disaster.
And if the capital gains rate happen to go up, it'll be even worse than it is now. Right now, it's a deemed sale at the current capital gains rate. Can you imagine if right now if they
I don't
go
have
up
to imagine. Are you kidding me? It's
Yeah,
already they're already writing down what they're going to do. So that little move where you don't complete the gift, depending on the circumstances. I mean, if we don't complete the gift and pay the gift tax, we can likely avoid a lot of this mark to market. Of course, the assets in the estate. So it depends.
But most asset protection trust offshore we would recommend an incomplete gift for this very reason. So there's no mark to market on the creation of the trust, and but you still get the protection of being in a foreign jurisdiction with these assets.
Exactly. So if we have a U.S. grantor who says, okay, I'm selling my business, I'm going to be subject to a huge indemnity obligation. I need a bomb shelter for part of these assets. I don't think anything's going to go wrong. I'm completely content with the deal. But I want a protective entity, not a tax planning issue, right? Sometimes even with not a tax planning issue, we don't, as tax advisors, we kind of try to be adverse to creating extra tax. We may want to, we could create the protective entity. We won't want to create more tax. So we go grantor by law under 679, because we've got usually a grantor here with at least kids who are US based. And then we at least get, if he were to die or she were to die, we get the step up, and then the deemed sale won't have any income tax effect because you've got the step up to fair market value basis. And we've protected everything. We haven't saved any tax, but at least we haven't created any tax either. That's common. It's kind of an opposite scenario with non-resident, non-aliens planning to come into the country, as if you haven't been stuffed with enough information already. Yeah, go ahead.
No, it's just, if it's a non-grantor trust, once you have this market to market, at that point, the foreign trust is treated like any other non-resident alien for the most part, with a few exceptions, the major one being the throwback rules for the accumulation of income within the trust, and then a later distribution of that to a U.S. beneficiary.
Yeah, that it's hard. They don't want you to accumulate without paying tax. And so for the U.S. person in general, there are kind of tripwires. It's typically not an estate and gift tax avoidance strategy. It's a protective strategy. For the foreign individual coming into the States, instead, the focus is not to bring all of the massive foreign assets into the estate tax net, and we can use a foreign trust for that, but that also is highly regulated. I'm guessing what's on the next slide, we're getting close.
All right, now it's time for fun. So now that we have gone through the mechanics of these different types of entities, what does it mean from the perspective of compliance? Well, if we have a foreign trust for whatever reason, Uncle Lenny is now the trustee in a foreign jurisdiction. They created it, and it was offshore, whatever it may be. Once it applies, from then on, as long as it is a foreign trust, there are certain tax information forms that must be filed with the IRS on an annual basis. And what's interesting is that it's not just for the U.S. deemed owner of a foreign trust, it's also for the U.S. beneficiaries of a foreign trust. And that's even if they don't receive, a distribution in a given year, they still have to file this return.
It's really a matching system.
Right. And so, it's due on the date of the individual's 1040, including extension. So this should be filed when the individual files their 1040, which hopefully will report, if they have income from these entities, it will be reported on their income tax return. But if not, then at least the IRS has the matching to know where the source is from these distributions and or gifts from foreign individuals.
Because the trustee's going to report.
Right. So this is something that you have to do. Now, the form itself is interesting. Part 1 of the form is all about the person, the donor who makes transfers to the foreign trust. They might not be the original grantor, U.S. grantor of the person that made it, but anyone that makes any U.S. resident that makes a gift to or a transfer to a foreign trust has to file this return. That's part 1. That's who it's for.
Yeah, that's how we track where those assets go, you know, and how the transfer may be taxed. They can look back to this form.
And that's based on in the actual year of the return. Part 2 is for the U.S. owner of a foreign trust, the deemed owner. They're required to file this annually as well. This also, it goes into when the assets were gifted or transferred. Also, would be where if you had a completed gift, where you would indicate the mark to market, where it would be shown, and you would have basis, and you would have the income tax, the information for the income tax for the U.S. grantor would then be imported to their U.S. return to report the deemed sale.
So that's where they know at that moment your basis is going to get locked in on later death, all kinds of problems.
Also, it's important to know for the U.S. Deemed owner, the U.S. grantor, that when you file this return, you will also need to attach a foreign grantor trust owner's statement from the foreign trustee who has also filed a month earlier the 3520A, which is the other compliance.
And then
form.
what happens, Brian, when we let's say we no longer have any U.S. beneficiaries?
Okay. Well, at that point, if 679 applied to the foreign trust, then in that given tax year on this form, you would have a deemed sale.
That's right.
Of all the assets that are in the foreign trust.
So the deemed grantor status, it's referred to, I find it odd. It's referred to the grantor, the founder of the trust, it's referred to as the owner. Right? I never get it. So what's happened is for income tax purposes, the grantor is deemed as continuing to own the asset, right? And then when the grantor dies, there's this deemed sale. But also, if for instance, like we've got families that come in from abroad, they're U.S. and they decide to go back. Well, as soon as you no longer have a U.S. beneficiary, it's like a death in a way. It's the deemed sale rules are triggered. It can be pretty onerous.
And it can be done by accident, not understanding how.
No, by accident?
Yeah.
Or just like complete disregard in one of the two. Yeah.
Right.
I don't know if it's accident or negligence, whatever it is, it is.
Okay. Now you also have compliance, the same big return. It also applies to any U.S. beneficiary of a foreign trust. So they have to file this form every year with their individual 1040, even if they don't receive a distribution. It's just informational matching. That's what this is. And if you don't do it, then there are issues and penalties attached. You will also, the U.S. beneficiary of a foreign trust will also receive a form from the trustee of the foreign trust, and that's the beneficiary statement that will be attached. So that's how the IRS does its matching, and also what the information would be on this return. They all go together and then are filed with the individual U.S. beneficiaries 1040 in the given year.
They should be.
They should be. They're supposed to be. And that's a big pitfall that we see is when they didn't receive a distribution in a given year. Well, I don't need to file this.
Right.
No, you need to.
Yeah. It's just
year.
informational. It's informational. We may do go ahead.
And then lastly, and this is also where we see a lot of pitfalls, if an individual receives a gift from a foreign person, individual, over $100,000 in a given tax year, even though no tax is due, they have to report it on this form. So it's informational only. It's not really income actually, but this is what's required. So
yeah, I never understood that one. It's just odd.
And then if you receive anything from a foreign business entity, it's only $16,388. You have to report it on this form. So it's very, it's informational. There's no necessarily tax due, but the IRS
But
wants to
there's
know
a
the
penalty
source.
if you don't do it.
Right.
Yeah.
They want to know the source. So these are pitfalls that we see a lot with these forms. Okay, now that relates to the U.S. grantor and the U.S. beneficiary of a foreign trust. Now, for the trustee, him or herself, or the entity, I guess if it's a corporate one, they every year must file a 3520A, and that is the income tax, basically informational return for the foreign trust. And it will relate to where the source of the income is from, where the assets are located, and it's also basically a snapshot of the beginning of the year, what all the assets are, the fair market values, and the end of the year. So the IRS knows what is in the trust every year, and if anything's been added to the trust.
And the value.
And the value.
And the value. Yeah, it's the way they can track. So, for instance, even if there's no death and there's no mark to market or whatever is happening, they'll know exactly what happened the prior year, and they're going to have a pretty good idea of what the tax liability is.
And the last thing is that this return is due on March the 15th. So as opposed to April the 15th. So you have a month before the individual's returns would be due because of the two forms that they have to fill out as part of this, the deemed owner form and then the U.S. beneficiary form that's attached to the individual's returns.
Yeah. All right.
Okay. Now the form itself, it's pretty straightforward. Part one is just the trust information. Where's the trust? Where's the situs? Who's the trustee? Where are they located? Part two is the income statement for the year, the source of the income, what it is, its character. And then lastly is that snapshot, the balance sheet of assets.
It's basically everything.
Right. And then these are the two attachments on the end. One is the foreign grantor trust owner's statement, as we discussed. It has to be done each year. The foreign grantor, quote unquote, the U.S. owner of the trust has to attach this form to their 3520, which will be attached, will be filed with their 1040. It's important to note if the trustee fails to prepare this form, the U.S. owner is liable.
Yeah, it's makes sense in a way. Actually, that's probably the only part of it that makes a whole lot of sense. They have to have that matching, and the trustee is sending out these matching forms, and they have to put somebody on the hook for making sure it happens.
And then you also have, along with this, the foreign grantor trust beneficiary statement. The deal's the same. It's done, early, so the U.S. Benny of the foreign trust can attach it to their own individual 3520, which is filed with their income tax return. The same thing here applies. If this form is not provided, the U.S. owner is liable. It's the same thing. Okay. Those relate to the compliance for foreign trust. If you're a U.S. income tax resident and you have foreign assets, there are certain informational returns you have to file each year with the IRS. One is the FATCA form. That's Form 8938. If you reside within the United States, the threshold is lower for the net value, or you have to report each year, and this is for the entire year, so that anytime during the year, your asset or your account, whatever it is, if it exceeds this amount, you have to report it to the IRS.
Yeah, we've had a number of these cases. What happens in many instances is that someone in the U.S., a U.S. citizen or longtime resident really, inherits an account or a property abroad and doesn't know anything about this reporting obligation. And years pass. Several years ago, there was a procedure you could go through as kind of a safe harbor. It wasn't very attractive, actually, but it was discontinued by the IRS. And the problem is, after several years pass, the penalties and interest amount to, it's so substantial that in a couple instances, it basically wasn't worth maintaining the property. It's so onerous. So just as a red flag, and Brian's going to work through the account compliance on the next slide. Whenever you see any property abroad, it's highly important that these both the FATCA and the FBAR be filed.
Right. So for FinCEN, the Federal Crimes Enforcement Network, we have the FBAR. That's also required for any financial account that exceeds $10,000, which basically almost any foreign account. You're going to have to file this, I mean, for the most part. And that's something that must be required annually. And as Gary already said, the penalties for the failure to file this, it's just informational, are draconian.
Oh, we had a teacher once years ago who she followed her spouse to, I think it was Norway. I can't remember what the exact facts were, but she had a small account and it was like $12,000, and she just couldn't. She got the account was tied up. It was a complete mess. But it's for real. It's for real. This reporting, it's kind of become the daily bread of a lot of European countries, and now you're gonna start to see some of the Caribbean countries take initiative with this reporting, both on the FATCA, FBAR, and the foreign trust reporting, just in general, because what's happened is the U.S. has started to crack down on not allowing certain deductions associated with visiting these countries or business events. It's called years ago it was called Caribbean Basin Initiative, but it's all the world's starting to become very, very small, very, very small, even in what you would consider a safety jurisdiction.
And then with technology now and this information sharing, these are much more, the U.S. clients are much more at risk than they were even 5 or 10 years ago.
Yeah, if you want some background on the information sharing or on treaties or on general estate and gift tax for a non-citizen, we'd be happy to send you my book on that. It was recently published, and it's got a nice overview on the whole area, including the foreign trust. It's got a little bit more flesh out. Brian did a heck of a job, though, fleshing out some of these rules. We really tried to keep it kind of interesting and an overview, but you can see how complicated you just can fall down the stairs on this. I mean, it's very complicated. Thanks again.